Hi, everybody, and welcome back to yet another cracking installment of the Map Round Show. This is the Private Placement Perspective series where we're connecting you to venture capitalists and guys basically managing growth capital. So with us in the hot seat today is Alex Ferber, the co-founding partner of Green Egg Ventures. Alex, welcome to the show.
Thank you for having me.
The privilege is all mine, man. So why don't you kick our viewers off and our audience off from around the world about what you guys are doing at Green Egg and how you got your start in the world of venture capital.
For sure. I'll start with the second question. I moved to New York from Michigan after university and wanted to work at a startup, wear a bunch of different hats, be part of a growing business, and I ended up getting super lucky. I interviewed at a venture fund called Metamorphic Ventures with the goal of actually working at one of their portfolio companies. At the time, however, they were looking for an intern and ended up bringing me on as an unpaid intern at that time. And I heard that, venture was difficult to get into. Decided I wanted to give it a crack and, decided to go on as an unpaid intern. Got a full-time position after a few months and just very, very quickly fell in love with venture. Every day we have the luxury, the luxury of meeting with people, solving, important problems with such innovative solutions and learning about new problems out there. And I knew I wanted to do it forever. So I worked at that firm for a few years, ended up leaving and co-founding Green Egg in 2016, which now I can't believe it's been 7 years. It feels like yesterday when we started it. The fund has evolved a little bit, but as we stand today, we are an early stage venture fund based in New York City. We invest in early stage startups that are solving problems for businesses. So everything B2B at the early stage. Where we focus a little bit more is post-product market fit opportunities in a $10 million valuation or less, and companies that are impacting the bottom line of their customers. So directly, adding to more revenue or decreasing costs.
Mm-hmm. So what's a typical check size? And do you have preferences around industry or stage?
Yes. So our typical check size for our initial check is anywhere between 100 to 200K. And for our follow-on investing is typically in the 300 to 500K range. Just by the nature of how we invest, post-product market fit, 10 million or lower valuation, typically startups that are getting traction might be at or above that valuation. So we tend to be investing more in first-time founders, maybe less sexy industries, when we're sort of nailing that lower valuation with post-product market fit. We're really looking for revenue-generating companies that, they do have the ability to exit in the billions for sure, but, as is the nature of venture, most companies exit in the hundreds of millions or less. So we want to make sure that we're getting a good multiple on those exits. So for us, we're really focusing on getting in super early at a low valuation so we could hit home runs even at lower exits.
What would you say makes you guys different? What do you want the startup community to know?
Yeah, it's a great question. As we pitch funds versus, talking to startups, the way that we communicate our differentiation changes. So talking to, startups, us as emerging managers, we are very much a startup ourselves. And I always tell any company that we're looking to invest in, talk to any of our portfolio companies before you take our money. We are experts in getting companies from that broker who's been in real estate for 10, 15 years, has an idea, doesn't really know how to navigate venture, sort of getting them from that really early stage to their first institutional round of funding. And there's ways that we help in terms of fundraising, whether it's connecting them to other funds or going in deep with them on their pitch and their decks, hiring for them. We'll literally put together lists of potential candidates that we're combing on LinkedIn, based off of different parameters that the company is looking for, pull the emails of the candidates and reach out on their behalf. Projects to help them generate more leads or close sales. They're very tangible. It's very tangible work that we're doing. We're creating these lists, really making things easier for the founders when they're focused on the things that could kill their company, like the product breaking or raising money. we're making sure to do a lot of the little things behind the scenes for them to make sure that their machine is well oiled and running. Now, from the LP perspective, there's other ways that we differentiate as well. One of the things that I hear is pretty different about the way that we work is that anyone that's involved with Green Egg Ventures, invested in our fund or an advisor, has complete transparency into our fund in two ways. The first way, which is more common, is seeing our performance to date. So all of our company's updates, all of our meeting schedules are there for anyone to go in there and see, the net present value of their investment in all of our companies, the latest updates. And what's more rare is that we share all of our deal flow in real time with all of our investors so they could utilize us for their own direct investing. For every company that comes to our deal flow, when we're passing, we're saying why we're passing. The decks are there available to everyone, filterable by industry, by the amount of money that the company is raising, the valuation, the location. So that level of transparency really makes it feel like people aren't investing into like a black box and hoping that 7 to 10 years later, there's more money than they put in, but being actually a part of the journey.
Very, very cool. Love it. Tell me, how much does the macroeconomics play into your decision-making around cutting checks? Obviously, SVB, good example, shit happens. Like things that, it's just like it's a like pandemic, there's always some drama, interest rates. Does it factor into your thinking around when to cut checks or not? And if it does, to what extent?
Absolutely. So, you have what's happening in this exact moment, and then you have what you think is going to be happening in the future, right? Which is anyone's guess. But, us venture capitalists, we like to have ideas of the way things are heading. So the one thing that's been really helpful for us at Green Egg is that we've always been very, very disciplined about under $10 million valuation, post-product market fit, right? When things got crazy during the pandemic, valuations ballooned. I mean, I think PitchBook just released that the average valuation in 2022 was like 20.89 or 21.89 million, which is outrageous. For us as a fund, we've always have been very disciplined in our approach, which has served us well, where now, profitability is important versus growth at all costs, right? Having a proper runway. We've been investing like that forever because, I've been around for a while just sort of saw how crazy things were getting. And we knew, these companies are all being told to raise more money. And now the venture funds are going back to them 6 months, a year later, saying, actually, no, you have to be profitable. So I know it's kind of not directly answering your question, but the answer is that we think about it all the time. But we're also, in the same way that with a public stock, people are trying to price it based off of, the future earnings of the company. The way that we're thinking of investing is sort of similar, but with less data.
Mm-hmm. So same question, but what's your view on LPs and how they approach the risk versus return, right? When it comes to venture investing, when things are uncertain, quote unquote, maybe they're taking hits in the public markets and now they're going, well, I'm going to take 10% of my portfolio and like literally gamble it. You know what I mean? So how does, it's almost chicken and egg to some extent. So from an LP perspective, how much of a role does that play?
Well, there's a lot of different kinds of LPs. So I'm just going to split them into two groups for the sake of this question. I'm going to split them into institutional investors or folks that are used to investing in venture and understand the space. And I'm going to also talk about LPs that maybe have real estate backgrounds or doctors, high net worth individuals, and see venture as like a place to diversify. I'll start with the latter. For those folks, there's when it comes to tech investing and venture, there can be a lot of FOMO, a lot of news that they're reading about these huge rounds of fundraising, they're reading about crypto, they're hearing about it. And it, for them, it's really about educating them on what venture is and if it makes sense, it doesn't make sense, right? So when I'm talking to somebody about venture who doesn't come from it, there's important drawbacks of investing in a venture fund or in the space, right? It's risky, it's very illiquid. Are two of the biggest ones. And I always tell people that come from that background, 5 to 10% at the most is what you would want to expose yourself to the venture space in general, right? So Thinking about LPs, they're going to be much less likely to want to invest in funds. If the markets are doing worse, they have less, ability to sort of see what else is out there. I think when money becomes tighter, people just are more comfortable with what they know, which makes sense. So that factor plays in, and FOMO plays in when things are going well in the markets and in tech stocks. Now, for institutional investors, they are meeting a lot of different funds like Green Egg Ventures, and they're playing a different ball game. So you have a lot of investors that might have public portfolios and private portfolios, and when, for example, the stock price decreases in their investments, now they might have only wanted 20% exposure or 15% to venture or tech stocks or to like a private stocks. Now, because their public portfolio is way depressed, their share of private stocks is much higher, right? So they're much more over allocated than they wanted to be to funds, which a lot of funds are finding right now, which can make it difficult for venture funds to raise from institutional investors. Now, I think that for an institutional investor to be an institutional investor in investing in tech, in funds and in the space, they are going to have an idea of the roller coaster ride of the markets and know that there's going to be times when the markets are depressed, times when things are accelerating. And I think that if you're in the space, you have an idea of, okay, technology is going to continue to change industries. It's going to continue, software is going to continue growing into new markets. So you need to sort of have that very long-term focus. So I think, for pre-seed and very early seed funds like Green Egg, we're expecting exits in 7 to 10 years. Who knows what's going to happen in 7 to 10 years, right? But as a professional investor, institutional investor, they're going to know that, okay, well, I know that things are kind of going down right now or maybe leveling out, but I know in the long run, I have an idea that things are going to generally be on the uptick. So it's just they could be a lot more resilient in markets like now than people that might just be coming to it without knowing it.
Yeah. So when it comes to actually cutting checks, like, what do you look for? What are the key factors that determine a yes from you?
Yeah, it's a great question. So, especially at our stage, it's really all about the founders. It's really about understanding, why are these founders the right people to solve this problem? What problem are they solving? Why are they the right people to solve it? And if they do solve it, is there a lot to gain from it? Are the big things? And then, of course, the other big thing would be, is this defensible? Is this differentiated than what else is out there? So those are really the questions that we're asking ourselves. For us, when we're doing diligence and deciding if we want to cut a check, we're getting really excited from people that can answer that question. And then, if we're talking to 5 to 10 customers of the company, hearing what their how their day-to-day work life has changed, from before they use this technology to after they've used it. And, they're not shutting up about it. They're going on and on about it. They're excited about it. Those are the types of companies that we want to invest in. Like you can't, a lot of people ask me like, well, can't they just tell the customers to say nice things about the company? Sure. But you can kind of tell someone who's going through the motions of talking about a product that they're using versus someone it's truly changed their lives. So that's a big piece for us in deciding to do the check is like the founding team and, how excited are their customers about using it.
What about common mistakes that you see? If you think about the last 100 pitch decks, you were like, no. Where does that go wrong?
That's a great question. I always like to point out to companies, like a broken record, that when a fund is looking at, unless it's coming from a source, coming from someone I trust and respect, I'm looking through during our deal meeting like 150 decks, right? I'm running through it over a couple hours or so, and it's like it's not like each one we're looking at over like a 20-minute period, looking at the space, the competition. You really need to stand out. There's a lot of amazing companies out there, and you need to really find a way to communicate why yours is different and special than the other ones out there. So I always like to give that context. A lot of people can get in the weeds of what they're doing. We as funds, as we pitch fundraising for our own fund, can get stuck in the weeds ourselves. So we get it. But you really want to give us the information that we want to have quickly digestible. Answering those questions that I brought up in the previous question is who are you? What's the problem you're solving? What's your solution? What's your traction? Where is this going? What's the big picture, right? I don't need to know all of the ins and outs of your product, all the features, functions, and everything. I would say that's a very common mistake, is that people just giving too much information and expecting every fund that they send it to really dig into every piece of it, when it's a much quicker process typically.
Alex, what's the biggest success and failure that you've had in the last 7 years, and what would you say made the difference at the end of the day?
That's also a great question. There's a fine line between when something works and getting lucky or not, and also when something fails. Sometimes things fail for reasons that are out of people's control and it just kind of stinks. The benefit, I'll just say quickly, of venture is that when you have a failure versus the success, the success makes up, like an order of magnitude for the failures, which is what's great about the venture space. So, a great success is a company that we've invested in called Acrolis. We were the first fund to invest in them. We exited at the Series C. Are close with the CEO of that company, who's an advisor to our fund, it's really in terms of what worked with that company. We spoke to a lot of the customers. Acrolis is a platform for lenders, and that's where they make a lot of their a lot of their money. But we were speaking to, I remember, divorce attorneys and accountants that were using their product, and they were so excited about it and so excited about the technology. And it was really just, the ability to see how that could really shift into a bigger area like lending, like mortgages. I think having that sort of, foresight and believing in the vision of the founding team served us well. And of course, there's luck involved with that. And I do enjoy companies that have some component of them that's not just fully tech. Like for Acrolis to work, they have some human in the loop to make it work. So we're not afraid of that as a fund. I think that could be a good competitive advantage. Now, failure, one of our first companies that we invested in, they were in the dating space, and they were doing really, really well as a company. But the dating space in general, there's like one acquirer in it. There's not many exits in it. So it was a failure of really understanding that it's not just how well a company is doing that you need to factor into it. There's other factors, such as, is this in a vertical where companies are being funded, acquired? Is there a risk of the company just running out of money if no one funds them? What's their runway like, right? The company doing well in itself isn't enough for success. So that was a very important lesson that we learned from there.
Speaking of lessons, Alex, what's your advice to a founder who's looking to raise money today from a venture capital firm such as yourselves?
So I would say to any founder out there that just by going through the motions of having an idea, putting it on paper, getting in a deck, pitching it, is way beyond what most people are capable of doing. So they should feel really good about that. And I really do believe that just by getting out there doing is the best learning, right? So to answer your question, I get so many cold emails and people reaching out, and we do look at we look at every deck that basically makes it through our spam filters. We go through it, we respond to everyone that comes through. But when this is your baby, and this is could be your future, your life, you really want to give attention to. You want to give proper attention to every fund that you're reaching out to, and it's so easy to tell when someone's sending out just my name is switched in with another fund. It's the same for us as a fund as we're raising, and it's, any fund out there could be the one that's the spark that makes the company work. And on our website, we say what we invest in, we say at what stage we invest in, and so few people actually go on there and look at it, and we can tell that right away. So it just have the respect for yourself to really approach each fund like a project, because that fund could really be the one that's going to catapult your business and change your life.
Treat the venture firm as an account. So you might have 10 VC firms you absolutely want to nail, and then you hit the people up in those 10 accounts, or firms in your case.
Absolutely. And you can find a lot about people and their backgrounds, and find overlap, and maybe even a connection that's someone that can introduce you warm. So absolutely.
Cool, buddy. Well, look, we're going to take a quick break, and now we'll hear from one of our sponsors. The Matt Brown Show is presented by Carafin, an investment bank that offers and supports direct private investments in U.S. operating companies. Over the past 20 years, investors have placed over $1.2 billion of private debt and equity in more than 100 companies through Carafin and its affiliates. Carafin leverages technology to empower its community of investors to deploy their capital far more efficiently than ever before, and connects their community of engaged investors with worthy companies. Invest portions of your portfolio in direct private investments today. Visit carafin.com/Matt Brown Show for more. And we're back. Alex, curious to understand how you manage portfolios and exits. So I'd love to talk to you about capital structures for a moment. So where do you fall, actually? Is it safe because everybody else somehow adopted YC safe notes very quickly, it seems. And then, a lot of firms like to price and go straight to equity. Some like convertibles. Where's your head at with all this?
Yeah, so we are basically, I think that we're at a point where we want to invest in the best companies, and the best companies get to choose their structure, right? So, we can have preferences. Of course, I think like a pre-money safe is probably the worst, and post-money safes could be great, honestly, because if they're stacking for a venture fund, there's like no dilution. So I don't mind that as much, but the founder could get in trouble with those in terms of their own dilution. Then convertible note, debt instrument. We've had exits that have happened where we held a convertible note, got our money out first with a multiplier. And then, I think equity would be probably the most preferred, although I do like convertible notes as well, but it's really up to the company at that time. I don't want them to go through an expensive process if they don't need to go through it as well. Yeah.
Mm-hmm. Where does this whole safe note story go wrong? Pre-money safe versus post-money safe?
Yeah. So in the past, companies would raise their seed round, their Series A, their Series B. This day and age, especially when money was cheaper, people were raising money every, 6 months, even less maybe. Stacking notes, just easy, right? You just change the cap. Someone wants to put in money. You want to raise the cap so previous investors are happy. But what happens is it gets very complicated very quickly, and it could hurt your fundraise if a fund is coming in and saying, wait, this founder, the way that we're pricing this round is going to have a lot less equity than we'd feel comfortable with at this stage in the business. So I think it's just important for any founder, especially people that are newer to the space, to keep in mind that these notes can get expensive for them very quickly if they're capping it, and being lazy could really hurt them in the long run. I think one thing that's important for any fund like ours to understand is how motivated is this person to make sure this company is going to work, right? And we spoke earlier about why are they founding this company, which is an important question that we can ask, right? Are they passionate about the problem they're solving? The other side of that coin is how much equity do they have? How much upside do they have? So that's that goes into that equation. So you have to be very careful with stacking convertible notes or safes.
Mm-hmm. Convertible note stacking, people. Beware. Yes. So, Alex, you've
Absolutely.
had, well, according to your website, I don't know if it's been updated, but you guys have had 7 exits to date. Very curious to understand, if you think about those 7 for argument's sake, how did you get to the exit? So it is in the sense of like, how do you approach and evaluate one? Do you just go, well, nothing's really changed from our initial thesis on this investment. The company's growing, the TAM's still there. We can just hold, and, screw it. Screw this investor. But sometimes, offers come along which are too good to be true. Or maybe the founders are no longer, or the team is no longer hungry to carry on, and they want to take some money off the table. So from your experience on those 7 exits, what happened in your world?
Yeah, well, typically you get an email out of nowhere that says, "Hey, we acquired." Usually you have some idea. Companies will say we're typically while they're fundraising, they might say, "Hey, we're also getting offers." As a fund, yeah, we've had 7 exits, but what I've preferred if some of them held on for longer. You really an exit isn't the same, right? If a company's exiting it under 5 years, it's probably not going to be a huge exit. And sure, it's great to double your money, right, on a company in a lot of different areas. But when you're building a portfolio of investments, especially like 32 that we have in our second fund, you really need those outliers to make the fund work. So, when the company sells, though, it just sells. We don't really have the option, and we're never going to be the fund that's like holding up the company from selling, right? That's just not like our core as a company is saying we trust you to make the best decisions for the company. As a fund, we're not going to be the fund that's going in and telling you what your customers want, how you should run your business. We're here to help you when you come to us for help and advice, but we're not here to tell you what to do. So, and then in terms of, there are times where we are offered to get bought out of our equity in a company. And at the end of the day, our responsibility is to our investors and our fund, right? As much as we want to hold on to investments sometimes, or we have friends that work at the companies that we invest in, if we see a pretty high valuation or, just could really, if our investors want us to, we can even ask them, "Hey, how do you feel about this?" Even though it's our decision at the end of the day. Our responsibilities to them. So if you see a deal that's too good to be true, and a later investor is willing to buy us out, we are gonna seriously consider it, which has happened.
Mm-hmm. So, what keeps you up at night currently, Alex, when you think of venture capital?
What keeps me up at night? So, venture. We're an early fund. We're an emerging fund. If you're a startup that just started a company and you convinced your friends and family to invest in your company, you have this idea, listen, anyone that's investing in a company or a fund should understand that their money is going to be tied up and they might not ever get it back, but you still want to reward the people that believe in you. You want to start the foundation for long-term relationships, at least as a venture fund. Return people money, have them join you for future funds. And there's a lot of people that grew up with that believed in me and that have shown that belief with their own hard-earned money. So when you run your own firm or you run your own startup, there's great, and you get more flexibility as a firm for sure than as running a startup. But at any moment, you could be doing things to advance your firm forward. And should I right now while I'm watching a movie instead be doing this or that? And you're constantly questioning your activities and I think it's important to have balance, but I'm very hell bent on making sure that the people that have believed in us and our fund and me and my team will be rewarded for it. And I want to do the best by their belief in me. So it's exciting. It keeps me up sometimes, but it's the good kind of keeping me up where I love what I do. And it's a good kind of uncomfortable.
And when you think about the next 10 years of venture capital, how do you see that evolving and what do you think its impact will be on founders?
Starting a company is continuously gotten cheaper and cheaper to do. More and more industries are being upended by technology. You have younger people entering into more established industries. You have new things, new spaces opening up. I mean, right now the buzz is generative AI. There's crypto and Web3, and there's all these new spaces. I can't even guess some of the things that will happen in the future. But what I do know is that more and more people will have access to starting companies. Companies will continue to be cheaper and cheaper to be founded, and innovation will continue. So I've never been more excited to be a venture capitalist and felt better about the future of where things are heading.
That's awesome, man. That's really, really cool. And tell me, if you could go back to yourself on day one in the Map Round Show time machine, no fun, no investments, no nothing, just wanted to, you dig this vibe. This is a cool space. This is where I want to be. What advice would you give yourself on day one, knowing what you know now?
Yeah. So I heard a quote or seen a quote, and I see a lot of quotes, but very few stick with me. This one stuck with me, which was that perfection is the enemy of progress. And I think for anyone that's looking to launch a fund or a company, and they're like, I need to have all my ducks in a row. I need to ask for everything firing on all cylinders, and really the process of doing anything just starts by doing something and learning on the go and getting in the habit of making uncomfortable decisions on a day-to-day basis, getting out of your comfort zone, learning lessons, hopefully not too expensive or hard, but they are hard lessons sometimes. So I would tell myself to just don't try to make everything perfect off the bat and make no mistakes, but to just start executing, start doing, and learn from the journey. And I think that applies to a lot of different industries and different things as well.
Mm-hmm. Well, Alex, you seem to be doing a lot of the things the right way, man. And I know that you're playing an important role in venture capital, period. I know a lot of founders who are looking to raise and so on and so forth. So congratulations on all your success so far, man. Here's to the next 7 exits.
Awesome. Thank you so much. Thanks for having me. Really, really appreciate the questions.
Anytime. Alex, stick around. Everybody, I'll speak to you all again soon.